Good morning, people. It's your friend, it's your sponsor, Michael Hayes of the Living Legacy Group. I am late. I don't know if you guys know, but I'm in Detroit and we won the game. And I think now that is 11 o'clock. And I didn't get to bed until like 4. So, congratulations to the Lions on their great win. And I'm going to look about getting this music turned down. Where's the volume? I got to find all this stuff this morning. All right. So how's everybody doing? How is everybody's weekend? I hope everybody's doing good. Well, we had a pretty good weekend over the weekend. We did do a lot of trading. We did do a lot of study. And I suggest you probably would do some study too if you're in the group, because this can be challenging right now. Bitcoin is hovering over. Let me switch over real quick. So this is where Bitcoin is. Where is my Cointelegraph? Coin market cap. So yeah, we're going to the championship. We're gonna go take them. We're gonna walk through. We're going to the Super Bowl, and that will be so glorious. Yes, it will. So over the weekend, I studied with Oliver, and I'd like to continue what I studied today into our 11 o'clock hour. It's obvious I won't be taking a lunch since I haven't even. Well, did I eat breakfast? No, I didn't, because I did have something early this morning, but I don't know if that counts. But thanks again for joining. Please like, subscribe. Please put your name in the chat and where you're from, so I can know where you're from and I can acknowledge you the proper way. And we were going to take a look at coins. We can see that the market is on a downswing. We're down to $40,000 with Bitcoin, which is still, I consider, a good opportunity to stick your toe in the water, find out exactly what it is that we're doing here, and what is the buzz that everyone's talking about. What is this cryptocurrency? What is these coins? What is this? What is that? Well, here at the Living Legacy Group, that's what we do, is we educate you on not just only cryptocurrencies, but all of the current stocks, options, commodities, whatever it is that's on the trading market. We have access to, and we will educate you on what you want to trade, whether it's gold, whether it's oil, maybe it's the Forex. How about crypto? How about Tesla or Apple or anything like that? So we here will teach you how to do that. So switching right over, we are going to continue to monitor. We are actually trading this token called Santos. It's a fan-based token. A token is a utility that is used to populate funds for the program that is being sponsored. So we're going to continue to trade Santos. I like the spread. It's really light. I was able to do some really good buys with the token. I'm getting very familiar with the token. I find if you find one thing, don't just give it up. Stick with it. Learn that pattern, because you can always bring yourself back. This will be your home base because it's so small. And what I found out, what I was doing, my major problem that I was doing is I was trading Bitcoin, and Bitcoin's spread is I think it's $10,000. So it had to move $10,000 before I even got one pip of a move. And moving like that was not good for our account, because every time we would not win a winning trade, it would, just the movement in the coin would send our account into negative territory. So what we learned to do is follow this specific pattern that I'm going to turn over to Oliver, and he's going to show you what to do. And I'm going to be sitting right here. I might have to get some more coffee or do whatever, but if I disappear from the screen, I'm coming right back. But I'm going to be sitting through this lesson. It is about an hour long, so we'll sit through this lesson, and then done with that lesson, then we'll go straight to the charts and see if we can identify some of the things that Oliver was speaking of, and see if we can also do some of those trades that he's speaking about. Okay, so with no further ado, here we go. I was watching him, so here we go. My friend Oliver Velez. You guys pay attention.
This is going to be the most reliable of any topping sign you can get. Okay? The dual or more topping tail bar from that 3 position. 90% of the time, you get a collapse, you get follow through, you get more red to come. Very, very powerful. 70% follow through rate, 70% follow through rate, 90% follow through rate. But you can also use this to make money every single day of your life in the market. Same concept, using 2 or 5 minute charts. This is what the vast majority of the world doesn't have. This is why they're afraid of downward markets instead of the downward markets being the most profitable market periods in existence. Instead of turning them into money, they actually get destroyed by them, but not you. I want to also teach you how you need to make money daily from the markets, or at least weekly. You need to know how to apply these things on a day-to-day basis so that you don't put money into the market, you just frequently pull it out of the markets. The numbers of people on the planet that know this is not very great. That's a very, very small number of market participants that consciously know this. And if you consciously know that the only way a market can start moving down and resetting itself is from one of these 6 pictures, and you know what starts that picture, which I'm about to get into now, my God, this is one of those parts of trading. This is one of the parts that makes you more elite than the majority of traders. What we're going to do first is lay an educational groundwork for how to read the markets from a global perspective. And we're going to then delve into the specific tops. And then we're going to go to actual charts and look at specific things based on the educational foundation we put in place regarding this, okay? So let's get back to business here. Surprises a lot of traders when I tell them that the market can only really do one thing over and over and over again. And some of you who are familiar with my work might remember this concept, but remember, repetition has a value here. It surprises some traders, or a lot of traders, I should say, when I explain to them that the market doesn't have a variety of things to play. It has one primary cycle that it repeats over and over and over again, and it can't do anything else. It's almost as if the market is trapped on rails. All right. Now, this is what I always use and teach to make all of my traders understand the fundamental movement of all markets in all time frames. And listen to me carefully. Every single thing I'm going to explain to you here today is applicable in every market, in every time frame. So you can stop asking, Oliver, is what you're talking about applicable to the stock market? Is it applicable to options? Is it applicable to Forex? Is it applicable to cryptocurrencies? It's applicable to everything because all markets operate based on human intervention between fear, greed, and uncertainty. So everything that I'm explaining to you is applicable across all markets in all time frames. That's short-term time frames as well as long-term time frames. Very important to understand. And what's also important to understand is that all markets operate off of one cycle, not 5, not 7, not 50, one cycle that repeats itself over and over and over again. This cycle is commonly referred to as the bell-shaped curve. Sometimes it's the economic boom to bust cycle, but this is the cycle of the market. It also happens to be the cycle of life. There is the boom side of the cycle here, and there is I should do this in a different color. There's the boom side of the cycle here. There's the bear cycle there's the bear side of the cycle to the downside. There is the top portion of the cycle here. And then we move right back into the bottom portion and we repeat. The market, I repeat over and over again, the market can do nothing else but do this: up, top, down, sideways, repeat, or bottom, repeat, I should say. So that's all the market can do. It's literally made up of 3 things, basically, well, I would say 4 things: up, top, down, bottom, repeat. Up, top, down, bottom, repeat. Up, top, down, bottom, repeat. Now listen to me carefully. I don't care whether you're trading with a 2-minute chart, a 5-minute chart, a 1-hourly chart, a daily chart, a weekly chart, a monthly chart, a century chart. I don't care how far you want to look in the past or how minute you want to look at your data. You're going to find this pattern, this cycle repeat itself over and over again. Now, let me tell you how this cycle is broken up. It is broken up into, as I mentioned, it's broken up into the bull portion, which is the up portion. You have the down portion, which is the bear portion. That's what everyone seems to be afraid of. We do the best in bear markets, actually. Then you have the top portion, which we'll talk about, and then you have the bottom portion, and then you just simply repeat from here. All right. Now, it's important to be successful in your market play, in any time frame, in any market. You have to first be able to determine which one of the four parts of the cycle are you in. Are you in the up portion of the cycle? Are you in the down portion of the cycle? Are you in the bottom portion of the cycle? Or are you at the top portion of the cycle? And so the first act of knowing what to do is to isolate where in your cycle are you playing. Where is your stock right now? What part of the cycle, based on the time frame you're looking at? What part of the cycle is the entire S&P 500 in now, based on the time frame you're looking at? If you are not constantly aware of that, there is no way to get your trading consistently good, because every part of the cycle requires a different approach in your trading. So if you think you're in a down cycle, but you're applying up strategies, you're going to be a losing trader. If you think you're at the top of a market, but if you think you're at the top of the market and you're applying top market strategies, but you're actually in the bottom part of the market, you're going to be an inconsistent trader. So you have to have the ability to determine where in the market cycle are you based on the time frame you're looking at. And you also must have a set of tools for each one of these parts. So you have to have topping tools, which we're going to talk about today predominantly. You need topping tools. What tools do you pull out when a market is at a top and it's going to crack from the top and start moving into the downward part of the cycle? You also need up tools, bottoming tools to profit from the upside. All right. So you need bottoming tools, you need topping tools, you need upside trending tools and downside trending tools. So you need basically 4 tool bags. You need to be able to determine where in the cycle you are, and you need to pull out the right tool bag that matches that cycle. Now, let me quickly demonstrate for you why it seems like there are more cycles than this that repeat themselves. Why is this so difficult to detect? It's quite simple. All right. It's quite simple. Here, take a look. This cycle is not always perfect the way I've just drawn it. Because sometimes, and let's say this is the left leg of the cycle and this is the right leg. Well, sometimes the right leg is higher than the left leg, but the cycle is still complete. All right. Bottom 1, 2, 3, top 4, 4 down, 1 repeat again. All right. And so sometimes instead of the right leg being higher, sometimes it's tricky to detect because the right leg is lower and the left leg is higher. But it's the same cycle. It's almost, guys, like a slinky where you have the left and right leg. They can be even or they can be mismatched like that, right? But it's the same cycle repeating itself. Now let's go back here. So in this scenario, you still have 1, 2, 3 top, 4 down, 1 repeat bottom again. And then, so the uptrend in your stocks will just be multiple cycles repeating itself. All of these are individual cycles. Cycle 1, cycle 2, cycle 3. It's nothing more than this cycle repeating itself over and over again. 1, 2, 3, 4, and 5. All right. And remember, there are different strategies to play in each part of these cycles. So you can have multiple cycles, cycle 1, cycle 2, cycle 3, in a massive cycle 2. All right. So you can have this massive cycle 2 that is really made up of a variety of smaller cycles repeating themselves. You can have this master cycle 4 that is really made up of a variety of smaller cycles repeating themselves like this. Each one of these is nothing more than this cycle with the left leg being higher than the right leg. And here the left leg and right legs are even. All right? That's the only difference. Now, it's important to understand as well that this cycle works upside down. All right? Same cycle, 1, 2, 3, 4, repeat, okay? And what makes it very difficult to understand sometimes is that the legs are different, that's all. Here, your left and your right are different, all right? Or let's do it this way. That's still the cycle, it's just slanted. It's just slanted. Instead of the left leg and the right leg being even, you've got the right leg down. All right? So left leg, right leg. And this is how you can cycle downward, where all you're doing, left leg, right leg, is repeating the cycle, all right, to the downside. This can be a larger down made up of miniature cycle downs. All right? And so it's important. I know when a trader I can determine the potential of a trader by this, by their ability to tell me with great consistency where they are in the stock cycle. So if I pull up a 2-minute chart and I say, where are we in the cycle? You'll say, we're in the top part of the cycle. We're in the bull part of the cycle. We're in the bear part of the cycle. We're in the bottom part of the cycle. If a trader can do that consistently, I can bring them across the finish line more often than not, because that's the basis for proper market play. All right. It's also the basis for what we're going to talk about when a market is ready to reset itself from the top. To me, being able to read the reset start from the top is one of the most important skills in trading, because it's the tops that destroy most traders. It's the reset from the top that typically that undoes every good thing that happened to a trader or a market participant in the past. So if they've been benefiting from the run up, what happens in the top is that the top, not being able to read the top properly or play what happens after a topping sign, a resetting sign, it wipes out anything that they earned in the up part of the phase. To me, learning how to read the top, learning how to play the reset to the downside is one of the most important skills in overall market play. Let me know if you understand. Just give me the word yes. Yes, I understand. Let me know if you understand that the market only has one thing it repeats over and over again. And this one cycle is divided into 4 parts. The left leg and right leg sometimes are even, sometimes they're unbalanced. And this is how markets move up and move down. They repeat this cycle over and over again. You got it? Good. Let's talk about the tops. There are 6 ways that markets top out in declines. But you know what? Before I do that, guys, before I do that, what I want to make sure you understand we're talking about here, let's draw this cycle again. And I want you to understand that I want to take you now. We know this cycle is broken up into 4 parts, okay? I want to take you to this part of the cycle right here. That part of the cycle. It's the 3 top part of the cycle. I want us to become experts at reading that, knowing that the probability of a reset in your market, a reset in your stock, a reset in your options, a reset in your Forex contract, whatever you're trading, a reset is due because you're able to read that part of the cycle properly and play it properly. So keep that in mind. We're focused now on this part of the cycle. Let's go. Now, there are 6 ways markets top out in that part of the cycle. Let's cover them. Top number 1, there are 6 tops from that 3 position. Now remember, we're talking about this right there. Okay? 1, 2, and 3. Here's 3. Okay? Here's 2, and let's say here's 1. Top out, this is what I call the steeple top. It will literally just be a run up and then almost an abrupt stop, as if your run has run into a brick wall, created a steeple like the steeple of a church, and boom, drops to the downside. And the way I used to demonstrate this for my trading kids is I want you to think of this as a steeple top or a cemetery where this stock is about to get lowered down into the ground. Boom! Okay? All right. Either way you look at it, steeple top. All right? Now, this is not the most common top. It's actually a little more common on the bottom, because everything I'm explaining to you is also applicable for bottoms as well. So the steeple top, the reverse of a steeple top, is a V bottom. So the reverse of this top would be a V bottom, like this. Boom. That would be your V bottom. This is a reverse V or a steeple top. Top, bottom. All right? But we're focusing on the tops here today. Now, the bottom V's happen more consistently than the top V's. The top steeple tops are not as common as the bottoms are. So this is probably, I still want you to be able to read it, but it's going to be your least frequent occurring top. The abrupt stop and the collapse, the immediate collapse to the downside. You'll see it, but not as frequently as what we're going to cover next. Now, the most prevalent top you will see is the double top. This is the most prevalent top after a run-up in all markets or in any individual markets. The double top is the most frequently occurring top. It is also happens to be the most powerful top, meaning that moves to the downside from double tops will tend to be the most powerful. All right? And basically what a double top is made up of is simple. It's an initial drop, right, that really starts some degree of concern. This is important. This drop is usually deep enough to cause some concern. All right? And what happens is that you leave some people up here wondering, oh my God, especially the people who have just bought in near the top. They bought in near the top, and this thing has dropped sharply from their buy point. And they're like, wow, am I in trouble? Did I buy at the wrong time? Then the market starts to come back on them, and they often will decide, once they get a good portion or all of their money back, they will decide, you know what? I'm out. This was scary enough for me. I'm out, creating sell pressure. So these people begin to sell, all right, causing what's commonly referred to as a double top, all right, and the collapse happens from here. This will be your most common top, the most common top you see. But the elements that I want you to understand is that this should actually be drawn a little bit deeper. This drop should be, it's not always concerning, but the more concerning, the better the odds that you top out near this first top there. There's your double one, and boom. Now I'm going to teach you to come into this play here to profit from the 4 leg. If this was the 1, this is the 2, your double top is the 3, you're going to ride the 4 into a 1 again. All right? But we have to be able to read the tops. So remember, you've got your steeple top, which is not all that frequently occurring, but it does happen. Then you've got your double top, all right? Your steeple top, I'm going to teach you to come in somewhere around here. I'm going to teach you the event that you're going to look for there. I am going to teach you in the double top to come in around here, okay? So that you profit from the 4. That's resetting the stock, resetting the market, repricing, I should say. All right. And then there is number 3. There's the what I call the left shoulder double top. So what you have in the left shoulder is higher. So it's not a true double top, because the left shoulder, here's the right shoulder, the left shoulder is higher. So what you have in this scenario is you've got a sharp drop that causes concern. You are leaving people up here wondering, did I make the wrong move? What's going on? All right. They are at a loss here, but the market starts to narrow their loss and narrow their loss and narrow their loss and narrow their loss, but it doesn't quite get all the way back to the top. And boom, you get this event here, which I'm going to teach you, that tells you you're not going to get the normal double top. This is going to be a lower top play that kicks you into this stage 4. All right. So drop and boom, not all the way back to the top. Okay. So that's the left shoulder top. And of course, you have the right shoulder top. Now, this is really quite interesting, because this is also a very powerful top, because what it does is it traps new traders that believe in a brand new bull run. It traps them in the play at a new high. So let me explain this to you. So you have this run up here. All right, here's one. You have this major run up, and then the stock cracks, leaving these people once again questioning, did I do the right thing? Am I going to have to take a loss? The market starts to narrow their loss, and actually it doesn't fail at or before, it goes through the high, all right, giving these people renewed hope. They often buy again. Others come in to buy the new high, all right, only to have this a failed new high that breaks back to the downside. Okay, this traps a lot of people in this, what's called a false new high. A false new high. Okay, I'm going to teach you to come into this around here when you're right back under the prior high and you have the proper event. Okay, now, again, the key elements that you want here: a concerning drop, a rally all the way back that takes out the prior high, usually not by a large margin, and then an immediate failure back below the prior high. Many people here in this area are trapped, and they will start selling out of their play at a loss, causing your stock to accelerate to the downside. All right? That is right shoulder top. So once again, you've got the steeple top, you've got the double top, you've got the left shoulder top where the left shoulder is the highest, and you've got the right shoulder top where the right shoulder is the highest. Okay? Now, number 5, you've got the 5 flat top. You've got number 5, the flat top scenario, where it looks like it's going to form a double top here, but it actually comes back, and you start to get this multiple top like formation in the form of a relatively wide sideways movement. So it initially looks like it's going to be a double top maybe, but it comes all the way back again and then drops again. And so once you get the third one, meaning that this is 1, this is 2, and you get a number 3, you're in a number 5 type top where you are vacillating back and forth, and the crack comes here where you break through the area of vacillation. All right? And so you have your 1, 2, here's your 3, your 4, your bear market 4, and then you repeat again. All right? And that is number 5. Now, some traders say, well, Oliver, what if this breaks out and moves to a new high? What is that? Well, that would prove that this is not a top. So let me give you some clues as to determine what's a pause versus a top. See, we're talking about a top, but there is something called a pause that has similar characteristics of a top. And I don't want you getting fooled by pauses versus tops. Notice the difference in my drawings here. Notice the top and notice the pause that I'm drawing. The pause is tighter. The pause is narrower. The pause is more controlled, whereas the top is a little wilder, whippier, wider, looser. Tops are looser than pauses. Pauses are tight, they're contracted. They're almost like coil springs that can continue to catapult you forward. Everything I'm explaining here is also applicable on the downside, traders. So you can drop and pause and boom, continue the drop. But if you drop and you're like that, that's usually a bottom. Okay? Wilder and whippier, and you break, and that's usually a bottom. Whereas at this tight, coiled, narrow is usually a pause, and you're not done with the downside. So you can drop, pause, drop, pause, drop, bottom. Okay? Same thing on the upside. You can actually run up, pause, run up, pause, run up, and top. They have different qualities to them. These are pauses, and this one's your top. And if you break, you know what's next. You're moving into 4. All right? That is top number 5. Okay? And then top number 6, you get sometimes, it's this sort of rounded, sloping top. It's not a V. All right? So it's not a V. It's not a double top. It's not quite a sideways top. It's rounded. Boom. Okay? And this rounded top, I would say that it's not the most frequently occurring, but it's more frequently occurring than the steeple top. So you still should know it. We need to know all 6 of the tops. Now, let's review all 6 of them. You've got the steeple top, you to the far upper left. You've got the double top. All right? You've got the left shoulder top, where the left shoulder's higher than the right shoulder. You've got the right shoulder top, where your right shoulder is higher than the left. You've got your basing top, where your stock is basing and vacillating back and forth from the top. There's this tug of war between the groups of traders that still believe the stock's higher and a growing group of traders that believe, no, we're topped out. And they're tug of war, and it's a tie right now until you get, boom, you break that. And then you have the rounded top that is a little bit more gradual, and boom. All right? And guys, I will tell you this. Listen to me carefully. There is no other way for a market to top. The value of knowing your 6 different type of tops is the values embedded in the fact that you will never be thrown by what if your market is topping or not, because no top can form unless it's one of these 6. If it's not one of these 6, it is not a top. If it's not forming one of these pictures that I've drawn from you, it is not a top. It's temporary. It's not a top. All tops fall from these 6 things. So what I want you to do is I want you to take a snapshot of this slide right here. Take out your phone, take a snapshot, or come back to this point in the presentation at some point in the future, and I want you to mark these 6 pictures down. Knowing the numbers of people on the planet that consciously know there are only 6 ways a market can top and start moving to the downside. All right. I know each one of the 6. The numbers of people on the planet that know this is not very great. That's a very, very small number of market participants that consciously know this. And if you consciously know that the only way a market can start moving down and resetting itself is from one of these 6 pictures, and you know what starts that picture, which I'm about to get into now, my God, this is one of those parts of trading. This is one of the parts that makes you more elite than the majority of traders. All right? There are a certain number of things that separate you from most other traders. This is one of them. Another one is stop adjustments, which is not the topic of our talk today, but stop adjustments is another one of those categories that separate you from almost all of the traders. Knowing the 6 tops and how to hit them is another element of trading that elevates you way above the majority of market participants out there. All right. All right. Now, let me know so far, guys, do this for me. I want to know if you understand what we've covered so far. You got this? Talk to me. I want to see your comments. I want to see your comments. All right. You got it? Whoa. Wow. Awesome. Boom. 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 Good. Now we're gonna get to charts. All right. I promise you, we're gonna get the charts here. Good. Yes. I want you to be more elite, just as a follower, just as a trader of mine. I want you more elite. These are the specific things that make you more elite. All right. Good. Good. Now, okay, so why don't we go to the next step? So now that you know, listen, now that you know, there's only one thing the market repeats over and over again. This one thing is divided into 4 pieces. We are focused on the top piece right now for this talk. All right? We're focused on the top piece, but understand there's only one thing the market can do over and over again, right? Bell-shaped curve. That bell-shaped curve is divided into 4 pieces, 4 parts. The part that we're zeroing in on is part 3, but your ability to read where you are in that cycle is the key to your consistency as a market player. You have to always know, no matter what time frame you're in, and we'll look at charts so that you can practice this with me. All right, we will do this today. But you've got to be able to know that always so that you know what tactics to bring out. But in this cycle, which we divide into 4 pieces, we're focused on the top portion of, or the number 3 part of the cycle, right? Not the bottom, not the up, but the top portion of the cycle. Now, what we're going to go over now, something needs to happen at 3. Something needs to happen at top. No matter which top you have, you can have the steeple top, you can have the double top, you can have the basing top, you can have the left shoulder top, you can have the right shoulder. Whichever top you have, something must happen. You can't anticipate it. You have to wait for some event to happen. And there are 3 main events, right? There are 3 main events that happen from these tops that I need you to know next. Let's go. All right. So there are 3 main bar types that top markets out in the 3 part of the cycle. Now, if you've been following my work for any period of time, you're going to know these 3 things. But again, repetition has a huge value when it comes to understanding deeply trading tactics and techniques. In addition to that, we're putting these 3 events at the right place in the cycle, in the right top. So the 3 things that I want you to there are more things, by the way, but the 3 things I want you to predominantly be aware of are bear elephant bars from the top. So a bear elephant bar is nothing more than an elongated, powerful red bar down. Boom! Like, think of if a bar could make a sound, it would make a boom like that. Not boom, boom. No, a bar that makes a heavy, powerful sound. Boom. All right? That's an elephant bar. Now, a topping tail bar is by definition a small body. This is a big body, but the topping tail bar is a relatively smaller body with a relatively long tail on it. It doesn't have to be super long, by the way, but it has a tail on it. All right. So think of shrinking the red down. Like think of taking this red and shrinking the red down to about here. And what do you have left over? You have the shadow of what used to be left over. You see, this topping tail bar was a red bar. It was a green bar at first. It was a green bar, actually. But what happens is that as it's going down from the high, that downward movement is really the color red. But the point I'm trying to make is that this is a downward movement. You get the color at the bottom, but it's a downward movement from the high. These are downward movements from the high. The stock traded up here at one point, it moved down from the high. So I often refer to these bars as sort of like bear torpedoes as well. They sort of look like a torpedo. All right. Now, the topping tail bar, let me just tell you this. The elephant bar, and I need you to write these numbers down. The elephant bar from a top, the bear elephant bar from a top has about a 70% success rate or follow through rate, right? You'll see I use them interchangeably. Success rate, follow through rate. What I mean by follow through is that you follow through with more red after this red. So there's more red to come. That's what I mean by follow through. All right. 70% of the time. Now, what does 70% mean? It means that if you were to do 10 bear elephant bars, on average, 7 out of the 10 will produce more red after the elephant bar has formed. Okay. So 7 out of 10 go lower. All right. Now, on the topping tail bar, you get about the same. It's actually maybe a tiny bit less, but it's so tiny. Let's just call it the same. So this is about a 70% follow through rate as well. All right. And just so you know, guys, I try to isolate for my traders the things that are 70% and above. All right. I don't teach. There are many things that have a 50% follow through or success rate, 60% follow through success rate. I don't teach those things. And there's a lot of them. What I try to do is zero in on 7 and above, 70% and above. I want you winning 7 times out of 10, 8 times out of 10, 9 times out of 10. I don't want you winning 6 times, 5 times, 4 times. I want it 7 and above. So everything you will ever hear me speak to you about, you can be guaranteed it's 70% and above success rate, okay? So your tail bar, remember, we're talking about the cycle. The tail bar has a 70% follow through rate. Now, 70%, 70%, 90%. Dual, or I'm going to say dual or more, because sometimes you might get triple tails as well, which count. So it's dual or more tail bars. You're in the 90 percentile. This is one of the most guaranteed topping formations you will ever experience in the market. This is the type of formation where you go to your neighbors, you go to your relatives, you borrow as much money as you possibly can and bet the farm. Now, I'm only teasing. All right. This is edutainment, so it's not trading advice. I don't want anybody, Oliver, you said no. But what I'm saying is that this is going to be the most reliable of any topping sign you can get. Okay. The dual or more topping tail bar from that 3 position. 90% of the time, you get a collapse, you get follow through, you get more red to come. Very, very powerful. All right. Now, I show you this dual topping tail bar with conflicting color because I want to demonstrate that really the color of the body doesn't really matter. I don't care if the little body at the bottom of my tail is green or red. It can be green here too. It's the tail portion that has the power. The power.
Well, folks, I am going to take a small break here. So stay tuned for part 2. I will stream it live. I'm still having some slight issuing, what they call it, encoding problems. But we're going to still work at it to see if we can get those issues taken care of. So thanks for joining for the morning session. We'll see you back here at 1 p.m. Thanks.